In recent news, the FDIC has once again seized another bank, leaving many wondering if this is just the beginning of a series of unfortunate events. The timing of this seizure is particularly alarming, as it occurred shortly after some major banks, including Bank of America, Wells Fargo, Chase Bank, and US Bank, experienced difficulties in processing ACH deposits. As a result, numerous employees across the country were faced with delayed pay on what should have been payday. Unfortunately, thousands of individuals are still waiting to receive their hard-earned money. The prevalence of deposit delays has sparked concerns regarding the stability of the banking system in America. It begs the question, are we witnessing the culmination of a crisis? The answer is no. In fact, I firmly believe that we are on the verge of experiencing hundreds more instances reminiscent of the Silicon Valley Bank meltdown. Allow me to break down the facts that have been overlooked by many, shedding light on what awaits us in the near future. Now let's dive into the details of the recent bank seizure. On November 3, 2023, the Iowa Division of Banking made the decision to close Citizens Bank in Sac City, Iowa, due to significant loan losses. The bank in question was declared insolvent due to its concentration of out-of-territory and out-of-state loans to a single industry, which resulted in significant losses. This predicament is not unique to this particular bank alone. It is representative of the current state of most banks in America. All major banks are facing severe challenges. Despite having set aside $7.6 billion to cover potential loan losses, it is becoming increasingly apparent that the situation is worsening at an alarming rate. To illustrate the magnitude of the problem, for context, consider the situation in March, around Silicon Valley. At that time, it was reported that banks had already incurred $620 billion in losses for the year 2022. It seemed like an enormous figure. However, as of March 23rd, the losses had skyrocketed to a staggering $1.7 trillion. It is undeniable that significant events have unfolded since March, suggesting that these losses have likely grown substantially. It is safe to assume that the current losses have surpassed $2 trillion and are probably even higher. Small banks are responsible for the majority of commercial property loans, with about 80% of such loans issued by regional banks, according to Goldman Sachs. Contrary to popular belief, it is not the big banks that are issuing these loans, but rather the smaller banks. This poses a problem, as these smaller banks are now facing a potential storm. Approximately $3 trillion of commercial real estate loans is currently held on U.S. bank balance sheets, and a significant portion of this amount belongs to smaller, less well-capitalized banks such as regional banks, credit unions, and small shops. If these small banks hold 80% of the $3 trillion in commercial real estate loans, they may potentially suffer losses amounting to around $2.5 trillion. To illustrate this further, let's look at the example of Blackstone, which is the largest real estate owner globally. Blackstone recently sold a building in San Francisco for $82 million. However, only 5 years ago, they had purchased the same building for $245 million. Typically, when purchasing a commercial property, buyers put down a 30% down payment and finance the remaining 70% from a bank or lending institution. In this case, if the building was purchased for $245 million, with a $70 million down payment and $150 million financed, the bank would experience a massive loss of around $70 million to $80 million due to the building's reduced value. This scenario is not unique to Blackstone or specific locations. Office vacancy rates are currently at 20% nationwide. A similar case involves PayPal, which occupies a building that was purchased in October for $72 million. This purchase price represents a 49% discount from the price paid in July. Another example is a property that was recently sold at a 47% discount compared to its purchase price 11 years prior. Wells Fargo also experienced a loss, selling a property for $40 million, which was 62% less than what they paid in 2005. These instances exemplify the widespread losses occurring throughout the banking system. These losses will likely continue to mature over the next 6 to 24 months. It is crucial to recognize that the situation is not limited to isolated incidents, but rather poses a significant threat to the entire U.S. banking system. The severity of the issue surpasses that of the 2008 financial crisis, where only a few institutions were affected.